Thank you very much. Thanks, Aaron, for that great, but sometimes often embarrassing kind of introduction. I sometimes wonder if they're going to put my 6th grade GPA in one of those long-winded announcements around who I was and what I've done over the years. But I'm really happy to be here. And boy, you guys have gone through what seems to be a pretty long day. And so I'm going to try and make this simple. I'm going to try and move around without breaking this table here to kind of make it a little lively and talk a little bit about gold in the macro crosswinds. So yes, we're getting a lot of attention, but before I kick into the content of the presentation, what I think would be good is just to make sure that you understand a little bit about our organization, the World Gold Council. And funny enough, we've been in existence for just about 38 years. And actually, we were founded by a core group of mining companies. The largest large-scale gold mining companies in the world decided that we needed an organization that could actually help educate and develop the markets in a way that's very positive. So that's what we do as an organization. For the last 30 plus years, we've been producing content, research, and information and insights around the gold market specifically, and ultimately trying to get people to better understand the asset so that they can trust it and they can invest in it very easily and feel confident about their decision to do so. I'm going to take my glasses off because I think the previous speaker talked about how bright it is up here, and it is extraordinarily bright. But just in addition to the content and education, we also look at the market and look at inefficiencies. And we spend a bit of our time thinking about what could be better, how could we improve it, why should we leave it as it is, maybe we can make it even better. So things that we work on in addition to the research and information around the data include market development initiatives where we might see a space in the mining area, like artisanal and small-scale mining, being done by bad people. And we say, let's tackle that and see if there's a way for us to bring policy work at the G7 or at developed nations or developing nations and see if we can resolve some of those challenges. But we also look at market structure, and digitizing gold is a big body of work that we're working on. All that can be unpacked later, but for now, what I want to do is talk to you about what's going on in the gold market, how we fit in, and here's a brief agenda of what we're going to talk about. A little bit around the macro environment, why gold, why now? A key component of why you should be considering gold, and actually the previous speaker talked a little bit about things that are working when fiat currencies are devaluing, and I like that, but I'd like to give you a little more insight as to why we think gold's a bit unique, and then ask the question and answer it for you, what could possibly slow us down? Because right now we're up 26%. We'll talk about all that. Look a little bit more around some of the alternative strategies, and then just kind of close up and do a little Q&A and move to a panel straight away. So let's talk a little bit about what's going on. So to date, as I mentioned just a moment ago, the gold market is up about 26%. Now what's been driving that have been a number of different factors. They include consumption by central banks, a gravitation for investors back to the market for holding gold as a diversifier, and ultimately global demand for gold in an environment where you might see the conditions in the US being something that may have held us back. So while the environment here was a rising inflationary environment, a potentially weakening of the dollar, the gold market was still rising. And actually, that's because globally, the demand for gold in some of those areas that I've just talked about was very much on the minds of investors and central banks. They're looking at their dollar exposure. They're looking at why they should diversify away from that. They're looking at their euro exposure and why they should diversify away from that. But the investors in the East, Asian investors, China, India, and Japan, have been buying record pace consumption of gold as part of their portfolio. But now where we are is that slowed a little bit. That momentum that's driven price up 26% is now sitting back and holding where we are. And what needs for us to have develop right now is this monetary condition in the US where we can start to see how the Fed and rates are going to ultimately respond and react to the work that they've been doing to try and tackle down inflation. And that's become more complicated with policy issues that are coming out of the White House and trade relations that are being questioned and so forth. So what we're looking for is when we will start to see those rate cuts. So we're looking right now at a near-term potential environment of stagflation, and gold right now is going to be held in a price range pending this rate cut environment. That's kind of our view. Our view is, let's see what develops next with the monetary policy that comes out of the U.S. When we see that rate cut happen, when we see those rate cuts happen between now and the end of the year, what you'll ultimately see is an opportunity cost of gold moving back into people's framework because it's actually beneficial to hold it in a lower rate environment. But you'll also look at that weakening of the dollar. And I think that's a big condition that we're waiting to see develop. Again, watching the near-term economic landing and what's going to move things. Now, why gold and why now? What I think is important, again, to remind everybody, we've been hitting record prices all year. Now, we've kind of topped out a bit. I think we hit near 3,500 in the U.S. And this is actually a condition that's actually been very interesting to observe because it's not only gold in U.S. dollar terms, it's gold in all foreign currencies where it trades. That's actually a unique feature of gold. Unlike Bitcoin, for example. Bitcoin only really prices in dollar terms. Here, we see the gold market seeing record highs across the board in all currencies. And that's actually one of our key messages. You need to understand that while gold is an important element for us here in the U.S. markets, it's a global asset. And the affinity for gold in markets like I've just mentioned, China, India, Japan, the Middle East, Europe, it's very high. And you need to understand that those are factors that could continue to drive the price. Those factors are slowing somewhat. Again, probably more of a condition on the U.S. dollar, U.S. rate environment, U.S. dollar asset environment that will actually push us beyond our 26% year to date. But again, remember, this is record level across the board, all currencies. And actually, here's what it looks like when you start comparing it against other asset performances. Looks pretty damn good. And actually, on average, what you should understand about gold is that it does return about 8% on average. This is data that dates back to 1971 when the gold standard was lifted. And people often misunderstand this and they often overlook this feature. This is the average rate of return from 71, 20 years, 10 years, 5 years. And by the way, all this information is available for you on our website. You can categorize it however you'd like. You can put the different comparative assets there. You can also pick your date range of whatever you'd like. But ultimately, what we try to remind everybody is even though you might have a year that gold's exceptionally well in terms of a performance, on average, you should be expecting it to return at that 8% level. Now, that devaluation of currencies, I'd argue, probably isn't 8% on average. I think it's probably lower than that. But here's what's really interesting about the gold market. What gets produced from the supply side pales in comparison to what gets actually consumed on an annual basis and the profile that you get. So gold production, mining, is only growing at about a 1% to 2% rate. It takes a lot of work, it takes a lot of energy, and it takes a lot of exploration to get a mining condition right to actually grow that. And right now, the outlook for that is continuing to be less than 2% on an annual basis. So you're always going to see this demand profile outpacing the supply profile. Think about that 8% when you think about what's happening in the market. And again, gold performs well during the good times and also during the bad times. And we'll talk a little bit more about that when we talk about diversification. But let me make sure that I highlight a real key feature, because I hear a lot of people talking about diversification and actually what they want and how they need it, and what is my asset going to perform, what's a return profile going to look like. This is probably the one feature that we make sure that we hammer home all the time with people. Gold is a very liquid instrument, and when you need to sell it, the liquidity is there for you. That's actually probably the most important feature. When you need it most, let's talk about like drawdowns in terms of market risk and so forth. Gold's $170 billion of daily trading volume is available to you. And you can trust it. And you can see transparent pricing on it. That's some of the features, those are some of the features that I think, and this feature in particular is a key element of gold. When I need it, I know I can use it. And quite candidly, when we surveyed 73 central banks, this is our 8th year of surveying central banks who have been buying gold at record or near record paces for the last 4 years, and for the last 15 years net buying gold. They cite it as one of the most important features that they need. I need to have a liquid instrument that I can rely on. And the gold Market gives them that. So let's talk a little bit about diversification and start with what everyone knows. Everyone knows that gold will do well for you when there's market risk and uncertainty, when you're scared, when risk assets are falling off. We have stats that talk about drawdowns. 14 of the last 15 drawdowns, gold performs exceptionally well. The 6 months after that, you'll see the performance of gold outpace any risk asset following those drawdown moments. So we know it works when the markets aren't doing well. But again, what is interesting about it and what makes it unique amongst particularly commodities and precious metals is that it's a monetary metal. So not only are people saving it for market risk and uncertainty, but they're actually spending and consuming it, not only in the form of savings and investment, but also in consumable goods when the markets are doing well. Simply put, if you get a little bit of money in your pocket, the jewelry market, which is one of the largest ways that gold gets consumed, comes back online and people feel quite comfortable spending in that consumer base. So what you find when it comes to diversification, the gold market tracks well on market risk and actually correlates negatively when the S&P, for example, which is what this chart is saying, when the market drops. When the markets are rising, it's actually positively correlated. So wealth creation, economic expansion, is how gold grows when markets are doing well, and market risk and uncertainty is how gold performs well when markets are selling off. So we think it's unique. We think it should be understood that you should hold a strategic allocation to gold and that you shouldn't think about it just for a rainy day. Now, what's interesting is that diversification is really a challenging kind of topic, and people often talk about, I want the right thing at the right time, but they need to have it behave the right way. Bonds and equities are correlated more than they've ever been. And that's simply because of a number of different factors, but including the fact that many of the institutions that would stand in between the bond market and buyers and sellers have disappeared. The risk capital is not there. So when people are selling, everyone's selling. When people are buying, everyone's buying. But money markets, money deposits, these are all things that should feel good and safe, but they're actually losing their value over time. When you look at a real rate of return on them with the declining value of the dollar, what looks to be a good yield is actually losing you money. And also, when you start thinking about what really becomes important when you're looking at diversification strategically, you're looking at purchasing power. And that's where gold is actually a strong asset for you. It holds its value and increases against devaluing currencies and also in an inflationary market. So when we think about the factors that are going to be driving risk and concerns and what's going to continue to drive tensions in the market, the geopolitical landscape, the risk of flare-ups, that's going to continue to be a big driver. That's likely to be a push for the market in a momentum way. But ultimately, we're again looking back at that crisis moment for gold and a key component in your portfolio, but also looking more importantly at what you should be considering when it comes to the strategic underlying value of gold and why you should be looking at it more than just as a momentum trade or a little tactical hedge. When you think about what could derail us, again, I'm going to talk to this slide a little bit because I want to make sure people understand it. This is how we help people frame how gold will perform. There are tactical drivers and strategic drivers. I talked a little bit about the strategic drivers. Those are the ones that are important for people to really appreciate. Economic expansion, wealth creation, growth in ultimately wealth and consumption, as well as risk and uncertainty, which is what gives gold that unique dual nature in markets that are actually performing well or performing poorly. But I think over the last 2 years, what we've seen a lot have been tactical factors moving us. That's why we've moved beyond that 8% this year. Opportunity cost and, more importantly, momentum. People expecting things to change. People expecting the fiat currencies to continue to devalue. The question around the role of the US dollar at a reserve level, but also in the form of a savings for the US itself. Those momentum items, those opportunity costs have actually pulled and pushed on the gold price and driven us beyond that 8% on an average basis. But don't get caught too much in the tactical understanding of gold. Yes, it will help you determine when and how you might want to think about buying, but more important than that, you should ultimately think strategically about what allocation works best for you. Now, the factors that are out there that could delay or postpone any further rise in gold or actually give us a headwind against any further ultimate upside for the gold market, if the rate cut environment becomes unmanageable or unclear, or the Fed really can't make a decision or determination of exactly what the economic conditions with tariffs, other factors in play, are looking like, they're going to basically sit on their hands. That'll continue to move us in range-bound levels for the gold price. If there's something that could ultimately rally the dollar, don't know what that could be. I don't see a lot of those signals on the horizon, but something that could do that for us could be an issue. I'm actually quite keen to watch what happens with stable coins and that role that they play and what they mean to the investment community. They could pick up the level of interest in the dollar, but fundamentally I don't see a big factor out there that's going to actually strengthen the dollar at this stage. And then ultimately as well, if there's something that happens in the credit markets that could ultimately put in play liquidity, and actually that could actually be an interesting moment for gold. We just did a very quick summary here. I was just given the 5-minute warning, so I'm going to kind of wrap it up quickly. But if you think about what are the key factors when you start looking at alternatives in a strategic allocation and what you should be mindful of, talk about liquidity, which is the second column. Does the asset provide liquidity? Does the asset have the right kind of volatility levels, low, medium, or high? You can actually see what our assessment of all these different assets that would be considered viable alternatives or a strategic allocation. Does it provide an inflation hedge? Interestingly enough, around Bitcoin, what it doesn't do is it doesn't perform like a safe haven asset. It doesn't perform as that kind of hedge against inflation. So while it does provide a significant amount of return on the upside, most investors that we speak to think about it as a proxy for the tech sector, and they think about it as a risk asset. So the previous speaker talked about an allocation of maybe some of the Bitcoin, maybe some gold. I think look at Bitcoin as a risk asset. Don't look at it as the safe haven asset that you might want. And that's simply because it doesn't provide a store of value. The use cases are not clear other than investment looking at speculative expected returns, and also ultimately a proxy for the tech space, because there's no indices, there's no liquid instruments where you could actually make a play on what the blockchain space will look like. And think about these three factors when you think about what you're looking for when you're thinking about this type of an allocation. Think about the returns that you're looking to achieve. Think about the kind of return profile you want from your asset. The diversification benefits, again, will your asset hold its value in the downside but also give you that upside performance that you expect? And never ever underappreciate the liquidity and the need for that when you ultimately have the opportunity or the need to sell out. Just very quickly, my closing remarks. I think we're all pretty clear that right now we're at a very precarious moment. It's very unclear as to how this administration, these negotiations at a geopolitical level are going to develop. We don't know. What we do know is that it's going to be a rough ride. It's going to be much more challenging for people to manage. And I think that that's going to be an environment that's here to stay. We've got an unsustainable debt level. We've got the concerns around dollars and dollar-based assets. I mentioned central banks. They're concerned about it. They're concerned around dollar assets, Treasury's performance, its ability to perform. And they're diversifying the gold. 95% of the respondents in our survey said they expect gold to play a key feature in central bank reserves going forward. Gold has surpassed the euro as an asset in central bank reserves. In addition to that, nearly 50% of our respondents said they're going to be adding their allocation to gold over the next 12 months. These are numbers we haven't seen in the 8 years that we've been doing our survey work. We probably will see a little bit less of a performance from gold in the short term until we can start to see the rate environment, again, accommodate the opportunity cost to move back to gold. And things that could pull us back, ultimately, if we do get 90 deals in 90 days, which we didn't, if we get 90 deals in the next 30 days, maybe that will help us out. But look, right now, one key element as well that I'm keeping a close watch on that I think we should understand is on the consumer side, the jewelry market has been slow. There are 4 key use cases: investment, central bank reserves, jewelry, and technology. that jewelry component, which is about a third, and still the largest portion of gold that exists in that $22 trillion market that was previously mentioned. And right now, that space is slowing. So will people come back? Will they come back in bar and coin? Will they come back in jewelry? How's it going to look? Will they gravitate to just a larger component of investment? And I think that's my own little signal that I'm done. And I think I'll kind of put a pin in it right there, maybe open up for a few questions before we bring the panel up. Is that right?
Yes, we have time for a question, sorry.
Great.
Anybody have a, okay, sir.
I'm not completely clear about the form of investment that I might make in gold. If I'm as interested in the GLD and or gold miners stock as a stock trader, seeking complete liquidity and complete expectation of return. Has that been performing as well as the expectation that you are?
This is a great question.
Or is it bullion and or gold coins that I should be leaning toward if I'm looking for that kind of return?
We get this question a lot, and it's a great question. So thank you. So when you think about making an investment in gold, you have two choices. I can go to the physical market and purchase gold, or I can use a financial instrument. As simple as that. I would say that's a different decision than owning a mining company. A mining company has a management team, they have a production pipeline, they have an all-in sustainable cost that they have to be producing below so that they can ultimately make money. And their performance, while driven partly by the gold price, may also be driven by copper, silver, and other items that are coming out of their mine. So it's a little bit more of a company decision impacted by the performance of gold, and that's a different investment. So now you're back to the world of, I just want to express an investment view on gold itself, and you're in the right spot. If you have a desire to just get the price performance, then the gold products that you're talking about, GLD and any physical-backed regulated ETF, will work efficiently for you. It is performing exactly like that, simply because it is tracking the bullion at the wholesale level, so you're getting the exact performance, net of a small management fee that erodes the price down over time to handle the things that you would handle if you were buying it in the physical market yourself. Transporting it, insuring it, storing it myself, and all the rest of it. Now, there's a little bit more detail that goes along with premiums and discounts when you start going down to smaller sizes and smaller denominations of gold, but it's really not that hard to unpack, and we got a lot of information on our website, and we would just say, take a little time, do your homework. If you want to own it in physical form, it's all very easy to get done. But if you just want the price performance, the regulated ETFs are perfectly suitable for you. I wouldn't say futures are a good place for you because they have embedded leverage and they have roll costs that come along with them, but they are viable if there's something that you're interested in. But price performance, tracking the spot price, ETFs work. GLD is a great example. It is that product, and I'm the principal executive officer. And I can tell you that the product has all of its gold, it's physically backed, and it works efficiently.
I think what we'll do is just have you take a seat, and we'll go ahead and roll right into the panel. That way there'll be time for Q&A at the end of the panel.
Okay, great.
Perfect.
But thank you for the question. That was a good question.